cheat sheet is a quick reference guide or concise summary of important information. Usually designed to help someone quickly recall key points, formulas, commands, or concepts.
In this segment, we look under the hood of some of the most successful investors from around the world to see what they are investing in. But Ren, today is a little bit different. We're not only...
Well, no, it's the same. We're looking at some of the world's most successful investors and how they suggest we invest.
True. Some of the biggest asset managers and how they suggest we invest.
Yeah. So today we're looking at three giants, Vanguard, BlackRock, and Betashares.
Yeah.
Betashares is an Australian giant. The other two, true global giants, trillion-dollar asset managers. But the reason we're looking at them is normally with Cheat Sheet, we look at, incredible active managers. Warren Buffett, Bill Ackman, Seth Klarman, Cathie Wood, whoever it is, and look at their portfolios and what we can learn from them. But all of these major asset managers produce model portfolios.
Yeah.
And essentially what they are core portfolios that they encourage advisors and the like to put their clients into. And so we wanted to take a look at the model portfolios from these three big product issuers and see how similar they were, how different they were, and also, probably most importantly, how they compared to our core portfolios.
Yes. So we're going to be covering three. The Vanguard Diversified All Growth Index, which is Vanguard's latest ETF, VDAL. Betashares Diversified All Growth, DHHF, and then BlackRock's All Growth SMA portfolio.
Yeah, now they don't have this as a listed ETF, but principles are the same. It's how they're encouraging advisors to invest. I think if you're on a platform, you can actually just buy the BlackRock All Growth SMA. But I think the principle we've applied here is we wanted to take the most aggressive core portfolio from each of these issuers.
Yep.
Because we're young, in a relative sense.
Yes.
We've got decades ahead of us, so we are not worried about getting defensive assets, cash and fixed income into the portfolio. We want our core to be focused on growth.
Big time.
So let's start by going through each of them and getting a sense of how they break up the world, like what they're investing in.
So we'll start with VDAL, the Vanguard Diversified All Growth Index. As it says, all growth, so it's 100% exposure to equities. Breaking that down geographically, 40% of that is invested in Australian equities and 60% is invested in international markets. So to break that down further, the fund has 5 Vanguard ETFs that make up the total portfolio, 40% in Australia, about 30% international unhedged, about 18% international hedged, and those are for developed markets. Then they have a small cap exposure of about 7%, and then they have emerging markets exposure of about 5.5%. So that makes up the total all growth VDAL.
Nice. If we turn to Betashares, 37.5% in Australia, 62.5% in international stocks. It's made up of 4 ETFs, and notably, not all Betashares ETFs.
Love to see it.
So whereas Vanguard was 5 Vanguard ETFs, Betashares have thrown the doors open to their competitors. It starts with the Betashares Australia 200 ETF, which is their Australian exposure, 37 to 38%. But then we have the Vanguard total stock market, 40% of the portfolio, SPDR developed ex-US 16 to 17%, and SPDR emerging markets 6%.
Yeah, love to see that. And then closing out with the BlackRock All Growth Model portfolio. So this is where they differ slightly. So 30% is held in Australian equities, around 45% is in developed market international equities, 9% in emerging markets, and then a mix of other asset classes. So 6% in global listed property through REITs, 7% in gold, and about 2% in fixed income and cash. So not all 100% global equities, I should say. A few other asset classes in there.
Yeah, so look, if you got a bit lost in those descriptions, let's break it down. Let's unpack what the key takeaways are and then compare how they compare to our core portfolios that we like to invest in. So for me, the first takeaway is how much they're invested in Australia. All of these ETFs and model portfolios are made for Australian investors, and they all have more Australian equities than I have. So Vanguard has the highest, 40% in Aussie stocks. Betashares is about 37% Aussie stocks. BlackRock is about 30% Aussie stocks. keeping in mind that Australia, based on market cap, is about 2% of the global stock market.
The other notable differences was around currency hedging. So Vanguard dedicates about 18% of the fund to hedged global shares. What this means, hedging is just taking out currency risk. BlackRock, about 8% is hedged to global equities, and DHHF is 100% unhedged. So you're fully exposed to currency movements of the underlying assets.
2 more takeaways. The next one is exposure to emerging markets. So Vanguard and Betashares were both about 6%. BlackRock, a bit more exposure to emerging markets at 9%. And then finally, total holdings. So we said Vanguard had 5 ETFs, Betashares had 4 ETFs. BlackRock's model portfolio was made up of 10 funds.
Yep.
So there's a few different divergences, but let's talk about how those compare to our core portfolios and what our thinking is.
Yep.
So why don't you start? Which of these 3 are you most similar to?
Which of these 3 am I most similar to? I'm definitely not BlackRock, because my core doesn't have any property, gold, or fixed income. So that's struck out. I would be most similar to DHHF. They have 37.5 Australian equities. I have 37% Australian equities.
Yep.
Wait,
you have 37% Australian?
Yeah, so the way it works is I contribute the same amount every month to all 4 ETFs.
Yep.
But because US and Australia are both geared, they consistently outrun.
Okay. And just for people who are new to the show, just quickly, what is your...
So Australian exposure is geared, GEAR. It's leveraged ASX 200. US is GGUS. It's leveraged US. And then I've got VAE, Vanguard, Asia ex Japan, and VEQ, Vanguard, Europe. So those are the 4. But yeah, it's actually 37% Australia, 37% US, 13% Asia and Europe.
Okay.
So I contribute the same amount to all 4 every fortnight. But because those 2 are geared, there's a consistent outrun. At the start of the year, I actually brought it back down because it was well above like 80-20. Sold some of it down, put it in. But yeah, they just are something I have to be mindful of. So yeah, what about you?
Mine is not like any of these in the sense that I have 4 ETFs as well, but they're all equally weighted. So 25% Australia, 25% US, 25% Asia, 25% Europe. And I think some like notable takeaways for me are my Australian exposure is lower than all of these model portfolios. I'm completely comfortable with that.
Yeah.
I'm more than happy I wouldn't want...
It's an Australian product bias for sure.
Definitely, yeah. And like Australia has some great companies, don't get me wrong, but the world has some amazing companies. And, you know, we're so exposed to the Australian economy in every other aspect of our life. Our jobs, if we own a home, our homes, just generally the Australian economy will dictate so much of our lives.
Yeah.
It's good to be diversified.
Yes.
Interestingly, currency hedging. So none of my ETFs are currency hedged.
Yep.
I'm 100% unhedged, and I think over the long term, I'm comfortable with that. So similar to the Betashares ETF in that sense. The interesting one is emerging markets. So if you think about both of our core portfolios, because really they're very similar, except you have leveraged versions of Australia and the US. Our Asian exposure would technically be emerging market exposure.
Definitely.
Because China, Taiwan, South Korea, that really in Asia, it's only Japan that wouldn't be classified as an emerging market. Yeah. And our Asia ETF excludes Japan.
Yeah.
So really our emerging market exposure is much higher than any of these model portfolios.
Absolutely.
Yeah. Yours, or you said yours was 13%, so only a little bit higher.
Yeah.
Mine's 25%.
So the fund itself, VAE, is 80% emerging markets.
Yeah, okay.
Yeah.
So I guess the concluding question, Bryce, as we look at this is having looked at these model portfolios from these big asset managers, is there anything you would tweak in your core portfolio?
I mean, the only thing for me to be wary of is just the weighting that I have towards Australia and the US, but I don't think there's anything I would change at the moment. I'm pretty happy with my core portfolio.
What do you think about BlackRock's move of having extra asset classes as part of the core? Gold, real estate, infrastructure.
I can understand it, but for me, for me, they're not bottom drawer.
Gold's not bottom drawer.
Gold would be.
Gold's been bottom
Gold would
drawer
be.
for like
REITs, though, I don't
14,000
think bottom
years.
drawer, unless you're going like global. I can understand, which they do. Just not interesting. It's just not my investing strategy. I can understand it. You do see it in a lot of portfolios, but I think, as we said at the top, I want 100% growth.
Yep.
And those are not classified as growth asset classes.
Although, like, depending on the time frame you look at, gold has smoked.
Yeah, absolutely. I think my main takeaway, though, is this is a good exercise. The reason we call it cheat sheet is you can go in and look at all of these asset managers and do this yourself.
Yeah.
If you can have a fiddle around just like we do. If you don't want to buy the fund, take some inspiration from it. And tweak it to what suits you.
Yeah, I think that is a good place to leave it.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful. Equity.